Good afternoon, everyone, and welcome to today's Henry Carmichael November 2025 budget webinar. Get things started. If you have any questions as you go through the webinar, please do put those in the chat, and hopefully we can get to those sort of at the end once we've gone through all the slides and information we've got to share with you thus far. Firstly, a few bits of initial introductions and things. As I said, welcome to the webinar with us. My name is Piers Galton-Becque. I'm a solicitor here at Henry Carmichael in the Private Wealth and Inheritance team, and joining me is Harriet Page, who is a trainee in our team helping out today with this. Bit of background about obviously Henry Carmichael. We are obviously the main focus today is the budget, and therefore private wealth and inheritance is the topic of today. But we're a full service law firm, and therefore, should you have any other questions or queries relating to any other area of law, whether that's business related or private individual based, we obviously as a firm can help with any of those sorts of issues. So feel free to get in touch with either us or any of the other departments to assist with any queries you may have in those regards. But moving on to the first point of the day. I don't know if anyone else watched the budget. Perhaps you sort of saved yourself at potential enjoyment there, but there wasn't potentially that many really key points for us to really dive into. Last year's budget had a great deal more fundamental and impactful changes. So there was a lot of sort of crystal ball gazing and perhaps doom mongering about what was in the second instalment. But things like change to lifetime gifting allowances, or perhaps further CGT changes, or there's a raft of things people were going through to full manifesto destroying tax changes, but there wasn't particularly any of that really. And so we've sort of picked out some main points here that we felt were really worth mentioning, as sort of main headline points. So as you can see here, the main topics we've got here to discuss are changes in regards to how you can save with your ISAs. We have the introduction of the new mansion tax, perhaps the sort of first real tax on the wealthy, as the Labour government has been pressured to sort of bring in there. Thirdly, we've got introducing the new transferable allowances for the agricultural relief and business relief allowances that were changed in last year's budget. So that's sort of a little bit of a tinker there from what they did last year. Now we've got also coming up tax increases for dividend savings and rental income. So we'll come on to that. And then lastly, some changes in how the pension salary sacrifice scheme is going to be impacted with regards to NI payments there. That's really the sort of main focuses we have regarding obviously our area of private wealth. There are some obviously lots of other more changes that talk about other areas, but we won't be talking about those in great detail today. So first up, we have the changes to the ISA allowances. So coming in from the 6th of April 2027, the usual standard amount of 20,000 being a tax-free allowance is still remaining the same. That hasn't changed. However, from April 2027, as I said, the amount that you can save in a cash ISA is becoming capped. That's 12,000. So therefore, if you put 12,000 into a cash ISA, that's you done. You then have 8,000 of your remaining ISA allowance that you then have to put into the remaining other forms of ISA, which is our innovative finance or stocks and shares ISA. So also you can put the full 20,000 into a stocks and shares ISA if you so choose, but from a cash ISA point, unless you are a pensioner over the age of 65, you will not have the ability to put the full £20,000 ISA allowance in a cash ISA. And obviously this is coming in from April 2027, so this is going to impact your new ISA allowance years. It's not retroactive in any sort of way there. From what the Chancellor said, these measures will form part of the government's wider strategy to develop sort of a greater retail investment culture and hopefully earn better return for savers. So they hope. So it remains to be seen whether or not that's possibly going to have the impact that they hope. But we'll see whether what comes from that. Moving on, the introduction of the mansion tax. So yes, as we said, this is the first real change they've brought into the tax of the wealthy, as it were. This is coming in from April 2028. There's now going to be sort of additional council tax surcharge with sort of various brackets that you see here. So if you have property that's valued between 2 and 2.5 million, there'll be an additional £2,500 per year. If you're in the bracket 2.5 million to 3.5 million, there's a further £3,500 there, and 3.5 to 5, an extra 5, and 7,500 if it's exceeding 5 million. So there's a chance as expected this, hopefully, to raise about 430 million by 2028, 2029. Not particularly impactful if there's that 20 billion black hole they keep referencing, but hopefully this will all add into the pot there. For clients to be really mindful of, if you find yourself in one of these brackets, is obviously that if you find yourself to be potentially a more asset-rich individual but cash-poor individual, so you're going to be struggling potentially to sort of reach those additional requirements for your additional council tax surcharge because all your assets are really locked into that property. There has been sort of a mention that there may be some form of deferral scheme that's going to be coming in place, hopefully in the coming year, I think it was, wasn't it? Where they're going to sort of offer options as to whether or not you can sort of defer the payment either in with some sort of repayment scheme over potentially a number of years, or perhaps deferred ultimately until when you either sell the property or perhaps when the homeowner dies. But those remain to be sort of looked into further, which I understand is going to be on a consultation hopefully next year. On this point, the manager tax is going to be collected by local authorities on behalf of the Treasury, but it's actually going to be collected directly by the Treasury, but used to help local authorities fund local services. So we'll see how that really pans out, really, with it, and how that impacts local communities in that regard. And the figures they gave out were that the Valuation Office is going to be carrying out valuations in 2026. The scope and range of which these properties are impacted by this are only around 1% apparently of all properties in England, and it's useful to know that social housing is not in the scope for that at all. Remains to be seen how they're going to carry these revaluations out, but there wasn't further information on that at this point. Something to keep an eye out for. Next, Harriet's going to talk about the agricultural property relief and business property relief changes.
So obviously this was one of the big changes in last year's budget, where it implemented a limit of £1 million for agricultural property relief, APR and business property relief. BPR, that's sort of still the case. It's still the case that it's a combined 1 million. You can't get 1 million APR and 1 million BPR. That'll still be coming into force from the 6th of April 2026. But one of the changes the Chancellor has made following consultations and obviously protests from the farmers is that spouses and civil partners will be able to transfer that unused 1 million allowance if they don't use it on the first death. So it means that if the full sort of 1 million allowance that they've elected to use, for example, APR, hasn't been used on the first death, on the second death, the executors of an estate can claim up to 2 million before paying any inheritance tax, and that's up to 3 million when the nil rate band and resident nil rate band are also utilised and available in full to be used. And then also one of the changes is that the threshold has now been frozen until 6th of April 2031. It was meant to be until the 6th of April 2030. So she has increased that by 1 year. And the new transferable rules for APR and BPR applies even if the first death occurs before the 6th of April 2026. I think she's just trying to widen that transferable availability to farmers. And this also does mean that she's brought sort of transferability of this relief between spouses and civil partners in line with the other transferable nil rate bans and allowances, which again, I think was one of the things that people weren't pleased with when this policy was first announced. So while she's not scrapped it completely or sort of changed the percentage amount, which I think is what a lot of people wanted, there is now a bit more sort of wiggle room and scope for people using these reliefs.
Right, yes. So next was what they brought in further changes to, so dividends and savings and property income. So there was a sort of flat 2% increase across the board. So firstly, for dividend income, that has now gone from the 8.75% for basic rate taxpayers, that's the current situation, with 33.75% for higher rate and 39.35% for additional rate taxpayers. There's the flat +2 to all across the board for those for dividend income, and that's going to come into force from the 6th of April 2026. Sorry, the higher rate was untouched for that, so 2% was only added on for the first for basic and higher rate taxpayers. However, property and savings income is facing the same 2% increase, but that's across all three brackets. So you'll be facing a tax rate of 22% for basic tax rate payers, higher rate taxpayers 42, and additional rate at 47, but that's coming in the year later, in April 2027. Property income changes will potentially see a separate tax rate introduced in your tax returns, as they're making a separate banding for property income. So that's something possibly to keep a lookout for based on the guidance we received from Treasury on that. And that's what we have in store for you on that regard. Coming up next, we have pension changes.
So obviously, again, pensions were a big story in last year's budget. They are being brought into the IHT net calculations from the 6th of April 2027. So obviously it does mean from that date, your pension pot is no longer exempt from IHT calculations, which obviously caused a bit of a stir. She has now made some further changes to pensions and what people can do with them. From April 2029, there's going to be a new cap introduced on salary sacrifice pension schemes. So where an individual takes a lower salary and that difference is then paid into their pension scheme. These were sort of all free from national insurance contributions on behalf of the employee and employer. She's now put a cap of £2,000 per year for employee contributions. Any contributions that go above this amount into such schemes are going to be subject to both employer and employee national insurance contributions. The costs of this relief, by not amending the salary sacrifice scheme rules, would look to be about 2.8 billion, was 2.8 billion 2017, was going to rise to 8 billion by 2030-31, which is why she's looked to bring this in now. And they estimate that the measure will raise 4.7 billion extra in 2029 alone when it comes in. It's important to note that employer pension contributions outside of salary sacrifice will continue to be free from national insurance contributions. And the Treasury has actually recently, since the budget yesterday, confirmed that employers will need to report the total amount of salary sacrificed through their payroll, and that guidance on this will be published before April 2029, but when it's coming out, we don't know that yet. So there's more big changes coming in for pensions.
And then lastly, we had a few sort of additional points that were sort of somewhat related to the area which we're talking about here today, but are not sort of immediately universally applicable. So firstly was one interesting topic of the news recently with the infected blood scandal, is that those payments for compensation that are coming out from that, when those do come down, it was announced that they will now be inheritance tax exempt. And some further clarity on that point was that should the initial recipient of the compensation unfortunately pass away before these payments are due to come out, the initial surviving living recipient will be able to receive those funds, and it will be tax exempt for them to pass it on. So whether they choose to gift it, excuse me, or when they pass it on in their own estate, those sums that were originally attributed to the compensation scheme will be exempt from IHT. It remains to be seen sort of how exactly that's going to sort of be detailed and sort of requested, but that's something to note. As I mentioned before, with the tax thresholds being frozen until 2031, we had the inheritance tax threshold being added a further year, as Harriet mentioned, from 2030 to 2031. That's going to tie in with the income tax threshold similarly being frozen until April 2031. So a lot of brackets obviously being frozen in place, but obviously with inflation and salaries increasing over time, that's going to bring more people into higher tax brackets over time. You're going to lose out on your allowances if you do things like dividend income coming down, or your basic income allowances being reduced should you move into a higher tax bracket, as you expect. So that's the dreaded fiscal drag everyone was talking about. So that's potentially incoming for everyone there.
And then back to pensions. I think after pensions got announced last year about being pulled into the IHT net, there was quite a lot of concern for sort of personal representatives, executors managing the estate with those. And they have actually now brought in new guidance, says that PRs will be able to direct pension scheme administrators to withhold 50% of taxable benefits for up to 15 months. And they will also be discharged from liability, so that's personal liability for payment of inheritance tax, on pensions that are discovered after the estate has received IHT clearance from HMRC. And I think that is something that I know a lot of legal professionals were sort of lobbying for, just to make sure that the executive and the personal representatives are protected while administering an estate. And then lastly, this is just for anyone that might have an electric vehicle. They've obviously gone up in popularity in recent years. There is now a new EV road charge that's coming in from April 2028, and electric vehicles and plug-in hybrids will be susceptible to a 3p per mile and 1.5p mile road charge respectively. So that's the full electric 3p per mile, plug-in hybrids will be at 1.5p per mile. This is in addition to the Chancellor extending the 5p cut in fuel duty until September 2026. I think part of her reasoning behind this is that electric vehicles use the road. So she feels that they should also contribute to sort of the maintenance of the many, many potholes that we're all dealing with. It is being reported that the EV road charges are assumed to be tied to the annual MOT requirements, where odometers will be read, so that they can get the mileage and therefore sort of make the correct charge for them. There is obviously probably some concerns that this is susceptible to tampering, so it really is going to remain to be seen how much this will truly have an impact on the Treasury's coffers.
And that really brings us to the end of our sort of a little quick whistle-top tour to the top points to address in this budget. Here's a little quick snapshot of who's been talking to you today, as we mentioned this morning. Here are our details if you ever want to get in touch with either of us about anything private wealth related, or like I said, if you want to get in touch about anything else that may be of interest to you, you can simply get in touch with us or anyone else here at Henry Carmichael, and we would love to assist with any of your issues. I don't know if we've got any questions coming through, but we'd like to deal with those if there are any.
No questions just yet, Piers.
Okay.
Obviously, if you have any questions following the webinar, then please do drop us an email, drop us a message on LinkedIn, reach out to us, and we will sort of try and help as much as we can. So yeah, I hope this is helpful. Like Piers said, a bit of a whistle-stop tour to sort of cover the changes that have been made. Not as dramatic as I think people were expecting, but there are still some changes to sort of really be aware of and look to start planning for as well, to get sort of your estates, your loved ones' estates, as sort of tax efficient as possible. So do just drop us a line. And thank you everyone for joining today.
Thank you very much.